Have you ever sat in like a buzzing, perfectly lit restaurant on a Friday night?
Oh, absolutely.
Right. You're watching the plates go by, you're listening to the clinking glasses, and you just think to yourself, I could do this.
Right, like how hard could it be?
Exactly. I could run a place like this. It's this really beautiful, romantic dream of owning a hospitality empire.
I mean, everybody has that dream at some
They
point.
do. You imagine the menu, the decor, the vibe. But then that romantic dream crashes really hard into the gritty, math-heavy reality of actually paying for it.
Yeah, the math is always the reality check.
It really is. So today we are opening up a stack of documents for this deep dive that basically act as the blueprints to the hospitality industry.
And these are some fascinating blueprints.
They really are. We are looking at the corporate profile of Bilat Santoring and Company. They're this powerhouse commercial real estate firm based in New Jersey. And we're looking at that alongside the newly released 2026 edition of the Little Black Book on Small Business Financing.
Right, which is authored by Richard Santor.
Exactly. And our goal today is to unpack the secret machinery of commercial real estate and restaurant financing.
Because it is definitely a machine.
It is. We want to equip you with the practical tools to understand how multi-million-dollar hospitality deals actually get funded, structured, and closed in today's economic climate.
Which is very different from the climate just a few years ago.
Oh, totally.
Yeah.
So let's unpack this, because before we get into all the heavy math and the specific loan structures, I think we need to understand who is setting the rules of the game here.
Right. It helps to look at the actual architects of these deals,
Yeah.
to understand how the industry functions.
Right. So tell us about Bilat Santoring Company.
So Bilat Santoring Company, or BSC as they call it, they were founded back in 1978.
Wow. So they've been around a while.
Yeah, a long time.
Hmm.
And their leadership structure tells you a whole lot about what it takes to actually survive in this space. You have two distinct pillars there.
Okay.
First, you have Barry J. Bialet. He's the strategist. He actually founded their boutique concept back in 1975.
Got it.
And then you have Richard R. Santor, who is the deal maker, the technologist. And together, they have facilitated over $500 million in financing.
$500 million. That's incredible.
Yeah. And they've sold landmark properties in New Jersey. We're talking places like Shadowbrook Estate and Rooney's Oceanfront,
Oh, wow. Okay.
right? So these aren't just, small corner cafes. These are massive, complex operations with incredibly intricate capital needs.
And their approach to moving these massive properties is actually pretty unique, like specifically what they call the branded selling cycle.
Yes, that is super interesting.
Right. They run this proprietary system through a digital hub, 123bsc.com. And basically, they match specific properties with highly qualified buyers using extreme confidentiality.
Which is so crucial in this business.
It really is. I mean, it makes perfect sense when you think about it. Like, if word gets out that a beloved local restaurant is struggling or even just looking to sell, the staff might panic and jump ship.
Well, the staff will absolutely panic.
Right. And then your vendors might suddenly change their payment terms. Like, they'll go from net 30 to cash on delivery.
Exactly.
Yeah.
Because they're scared they won't get paid.
Yeah, and then the entire value of the business could just plummet before the ink is even dry on the contract.
Yeah, and it goes beyond just vendor panic, honestly. The value of a hospitality business is tied entirely to its momentum.
Momentum, I like that word for it.
Right, and momentum is incredibly fragile. A restaurant is like a living, breathing ecosystem. Keeping a potential sale quiet preserves that ecosystem until the new owner actually takes the keys.
Makes total sense.
But, I think the most critical context in this whole stack of sources is the massive shift in the broader financial landscape.
Right, the shift that the 2026 edition of the book highlights.
Exactly. The era of easy money is officially over.
Yeah, Santor makes a huge point about this transition. Like, the old benchmark that banks use to calculate interest rates, so LIBOR, is just gone.
Completely gone.
We are now fully entrenched in this higher rate environment.
Right.
We're dealing with SOFR and prime-based pricing now.
Which honestly fundamentally changes the math for every single borrower out there.
How so? Like, break down what LIBOR was versus SFR4.
Well, LIBOR was essentially an honor system benchmark that banks used to lend to each other.
An honor system for banks. That sounds risky.
Yeah, exactly. It was easily manipulated and ultimately got phased out. So now we use SOFR, which stands for the Secured Overnight Financing Rate.
Okay.
And that is based on actual, transparent overnight transactions. So it is a much safer metric for the entire financial system.
But I'm guessing there's a catch for the borrower.
Of course there is. It also means the baseline cost of money is much stricter. Mechanically, the cost of capital is materially higher now than it was pre-2021.
Right.
When interest rates rise, those monthly debt payments absorb a much larger percentage of a restaurant's cash flow.
So the margin for error just shrinks.
Dramatically. Which is why lenders now have zero tolerance for overly optimistic projections.
Yeah, I mean, reading this, it sounds like pre-2021 was basically an all-you-can-eat buffet with no cashier.
That is a great way to put it.
Right. Like, money was cheap, everyone was piling their plates high, and nobody was looking too closely at the tab at the end of the line.
Nobody at all.
But now, it's like this 2026 lending environment is acting like a strict nutritionist.
Oh, absolutely.
Every single calorie is counted, every macro is tracked. There is absolutely no room for junk food in your financial statements anymore.
No room at all. Lenders are scrutinizing liquidity, and they're demanding this crystal clear understanding of operating risks.
Okay, so that strict scrutiny has to change how deals actually get approved.
It changes everything about how a deal is underwritten. I mean, lenders are demanding heavily documented management experience now, and they are stress testing every single projection you hand them.
Which, to me, raises a pretty fundamental question here.
What's that?
Well, if money is so much more expensive now, and if the underwriting is acting like this strict nutritionist, why do lenders still consider restaurants financeable at all?
That's a fair question.
Right. Because the industry is notorious for high failure rates. You'd think a bank would just run the other way and say, let's go finance something safer, like a dental office or a warehouse.
Well, they will still finance restaurants, but only because of the structure.
Structure, okay.
Yeah. Centaur's book points out that restaurants remain highly financeable, provided the financial architecture is built correctly.
What does that architecture look like?
Lenders look for experienced operators who can demonstrate really strong unit economics. They also want to see transferable permits, like liquor licenses.
Oh, because those carry immense intrinsic value.
Exactly. A liquor license alone can be worth a fortune. But really, the absolute secret here is matching the debt to the useful life of the asset.
Okay, wait, let's pause on that. Matching the debt to the asset, meaning you don't use a short-term credit card to buy a 30-year building.
Right.
And you don't take out a 30-year mortgage to buy paper napkins.
Precisely that logic, yes, but applied across millions of dollars.
Got it.
You use long-term debt for real estate.
Right.
Then you use medium-term equipment loans for things like your ovens, your hoods, walk-in refrigerators, things that might last, say, 7 to 10 years.
Okay, that makes sense.
And then you use short-term credit lines, strictly for working capital, to smooth out seasonal bumps in cash flow.
So everything is compartmentalized.
Exactly. When the capital stack is organized logically to match how long those assets will actually generate revenue, the bank's risk is minimized, even in a volatile industry like hospitality.
Okay, so if lenders are still at the table, how exactly are they judging a potential owner? Because getting a loan approved requires this total shift in perspective from the borrower.
It really does.
You have to stop thinking about the what, like the beautiful menu, the custom lighting, the brilliant concept you've dreamed up.
Right, the fun stuff.
Exactly, the fun stuff. And you have to start thinking entirely about the how, the daily operations, and the underlying math.
Because a lender is not underwriting a dream.
They don't care about your dream.
Not at all. They are underwriting the mathematical probability of repayment. Period.
Right.
According to industry standards detailed in the text, every credit decision basically boils down to a framework of 5 core questions.
Okay, what are they?
First, who is operating the business? Second, how much cash flow is available? Third, what collateral supports the loan?
Okay.
Fourth, how much equity is invested? And finally, what could go wrong?
Let's fill in that second thread, cash flow. Because this brings us to the absolute magic metric of commercial lending.
Oh yeah, DSCR.
Exactly, DSCR, or debt service coverage ratio. So Centaur highlights that a standard DSCR in this environment is 1.20x.
Yes.
So to break that down mechanically for you listening, if a business has a DSCR of 1.20, it basically needs to generate $1.20 in actual net operating income for every $1 of debt it owes the bank.
Right. And that extra 20 cents, that's the lender's margin of safety.
It's basically a financial shock absorber.
Exactly. And the bank demands that shock absorber because they know the reality of the restaurant business.
Stuff breaks.
Stuff always breaks.
Mm-hmm.
Eventually, the walk-in freezer is going to break down on a busy Friday night, or wholesale food costs are going to suddenly spike, or the roof is going to leak.
Right.
If your business model only generates exactly $1 for every dollar you owe, the moment that freezer breaks, your cash flow goes negative.
And you default on your loan.
Exactly. And depending on the perceived risk, that shock absorber might need to be even bigger.
Oh, really? Like more than 1.2x?
Oh, for sure. For a startup, or maybe a turnaround project, a lender might demand a DSCR of 1.35x or even more.
Wow.
But look, cash flow is only generated if the business is actually run efficiently.
Yeah.
Which connects directly back to the very first of the lender's 5 questions. Who is operating the business?
Right, the management experience.
Exactly. The text places a massive emphasis on this. They want to see direct, hands-on experience with things like food costs, labor scheduling, point-of-sale systems, and payroll.
Okay, wait, hold on. Let me play devil's advocate here.
Go for it.
If I have a Michelin-starred chef creating this revolutionary menu, and I've got a wildly unique concept, right?
Okay.
People are lining up down the block every single night. Are you really telling me a bank will turn me away just because I haven't personally built a labor matrix or managed a sanitation schedule before?
A bank will absolutely turn you away.
Seriously?
Seriously. Or, at the very least, they will require massive outside guarantees. Look, a great menu cannot save a business with bleeding operational margins.
That's a great point.
Lenders know that the difference between a highly profitable restaurant and a bankrupt one often has nothing to do with the quality of the food.
It's the back of house stuff.
Yes. It comes down to the labor matrix,
Yeah.
inventory control, and waste management. If you don't know how to track breakage or optimize a vendor contract or schedule staff efficiently during a slow Tuesday lunch,
Yeah.
the bank knows that your Michelin-starred food will just be a very delicious way to lose their money.
Wow. That is a brutal reality check, but I mean, it makes complete sense.
It does when you look at the math.
So, okay, assuming the operator does have the right resume and the DSCR math checks out perfectly, what actual tools do lenders pull from the toolkit to fund the deal?
Well, let's dive into the capital stack itself.
Right, the loans, the leases, and I guess the potential landmines.
Exactly. So a massive portion of this ecosystem actually relies on the Small Business Administration,
The SBA.
the SBA. And the book details 2 distinct paths here that serve very different purposes.
Okay, what's the first one?
First, you have the SBA 7A program. This is the federal government's primary small business loan program, and it offers up to $5 million.
Okay.
This program is heavily utilized because it is perfect for financing a mix of assets.
Which is important because when a buyer acquires an existing restaurant, they aren't just buying physical tables and stoves.
Right, they're buying a lot more.
They're buying goodwill, the brand's reputation, the customer list, and leasehold improvements. And a conventional bank, they hate financing intangible things like goodwill.
They despise it.
Right. Because if the business fails, the bank can't foreclose on a good reputation and sell it at auction to recoup their money.
And that is exactly why the 7A program exists.
Yeah. How does it fix that?
The government steps in and provides a guarantee to the lender for a large percentage of that loan. So because the government is absorbing that specific risk, the bank suddenly becomes willing to finance those intangible assets alongside the tangible ones.
Which allows a change of ownership to actually happen.
Exactly.
Okay, so that's the 7A. Then there is the SBA 504 program, which operates on completely different mechanics, right?
Literally different.
Centaur notes this one is built for major fixed assets. So specifically things like owner-occupied commercial real estate or heavy, long-lasting equipment.
Right. The 504 program is fascinating because it uses this sort of tag team approach.
A tag team.
Yeah, it pairs a private sector senior lender, like a traditional bank, with a certified development company, or CDC.
Okay, and what is a CDC exactly?
A CDC is a nonprofit set up to support economic growth. And what they do is issue a debenture. Staff debenture.
Yeah, which is basically just a long-term bond backed by the SBA.
Okay, so how does that tag team approach actually break down the risk for everybody involved?
So the traditional bank takes the senior position, covering maybe 50% of the total project cost.
Okay.
Then the CDC takes a subordinate position for about 40%.
Subordinate meaning they're second in line.
Exactly. Being in a subordinate position means that if the borrower defaults and the property has to be sold, the traditional bank gets paid back in full first.
Before the CDC sees a single dime.
Right. So because the CDC and the government are willing to take that hit first, the traditional bank feels incredibly secure.
That makes sense.
And as a result, the borrower gets great long-term rates, and they might only need to put down like 10% to 20% in equity.
That is a highly engineered way to stimulate business growth while basically completely protecting the primary lender.
It's very smart.
It is. But within all this commercial real estate financing, there's a concept that acts like a hidden trapdoor for new operators.
Oh, yes. It's the crucial difference between amortization and term.
This trips up a massive number of first-time buyers. I mean, it's so common.
Break it down for us.
Okay, so amortization is simply the mathematical schedule over which your monthly payments are calculated.
Right.
The term, on the other hand, is the actual date when the entire remaining balance of the loan is due.
And Centaur highlights a massive trap here. The balloon payment.
The dreaded balloon payment.
Right. So say you secure a commercial loan that amortizes over 25 years.
Okay.
Your monthly payments are relatively low, right? Because they're calculated as if you literally have a quarter century to pay off the debt.
Sounds great on paper.
It does. But the term matures in just 5 years.
Yep.
That means on month 60, the bank expects a massive multi-million-dollar check for the entire remaining principal.
Which nobody just has lying around.
Exactly. So why would a borrower ever agree to a structure that guarantees they have to scramble to refinance their entire business in just 5 years?
Well, because that structure manages interest rate risk for the bank.
For the bank, not the borrower.
Right. Look, in commercial lending, banks are absolutely terrified of locking in a fixed interest rate for 25 years.
Oh, because of inflation.
Exactly. What if inflation spikes dramatically in year 10, like we saw a few years ago? The bank would be trapped, losing money on that loan.
Oh, I see.
So by forcing the term to mature at year 5 or 7, the bank gets an automatic opportunity to reset the interest rate to whatever the current market reality is.
And the borrower just accepts this.
The borrower accepts it because it keeps their monthly payments affordable in the short term. It allows them to actually operate. But yes, it means you have to be acutely aware of that impending maturity date.
You have to be prepared to refinance.
You have to be.
So that balloon payment is basically a ticking clock, but the logic holds up. Now, what if the bank says no, or a borrower just needs immediate emergency cash?
That's where things get dangerous.
Right. The text dives into alternative capital, and it makes a very stark distinction between a traditional line of credit, which you use to bridge a predictable seasonal gap, and a merchant cash advance.
Right. A merchant cash advance, or MCA, they operate totally outside of traditional banking rules.
How do they work?
They provide a lump sum of cash today in exchange for a percentage of your future sales.
Okay, so they take a cut of your daily sales.
Exactly. They collect it through fixed daily or weekly withdrawals directly from your business bank account.
Looking at the mechanics of this, I mean, a merchant cash advance, with its daily withdrawals and incredibly high effective costs, it acts basically like the payday loan of the restaurant world.
It really does.
So why would any rational, smart operator ever use one?
Well, Centaur's text is very clear on this, actually. MCAs are useful only for highly specific, short-term, high-return emergencies.
Like, give me an example.
Okay, imagine it's Friday afternoon. Your primary commercial pizza oven dies.
Oh, nightmare.
Absolute nightmare. And you have a fully booked weekend with massive catering orders.
Okay.
You need $15,000 immediately to replace the oven, or you are going to lose $50,000 in guaranteed revenue.
Right, you're stuck.
Exactly.
Oh.
A traditional bank loan will take weeks of underwriting to approve. An MCA can literally deposit the funds in your account in a matter of hours.
Oh, wow.
So in that isolated scenario, paying a really steep premium for the cash makes financial sense.
Because it saves the weekend's revenue and protects the brand.
Exactly.
But the danger comes when operators use that expensive capital to cover up a leaking ship.
That's the trap.
If your underlying labor costs are just fundamentally too high, taking an MCA will destroy your business.
Quickly, too.
Yeah, those daily withdrawals will silently choke whatever little cash flow you have left, accelerating a bankruptcy rather than preventing it.
Which is exactly why understanding these structures is so vital. But, knowing the loan types is really only half the battle.
What's the other half?
The pitch.
Yeah.
How do you actually present your case to a bank without stepping on a hidden landmine that kills the entire deal before it even starts?
Right. So the book outlines the loan requisition presentation, and there is a massive emphasis on the executive summary.
The rule there is simple. Do not bury the lead.
Yeah. In the very first page, the lender needs to know the exact loan amount requested, the specific use of funds, and the primary source of repayment.
Exactly. You do not start with a 10-page poetic backstory about your grandmother's marinara sauce recipe.
Right. You start with the math.
Always the math. Underwriters review dozens of files a week. If the math doesn't immediately fit into their credit box, The history of the marinara sauce is totally irrelevant.
And that brings us to how operators present their financial projections. Because the text warns that lenders will immediately reject flat percentage growth
Oh,
projections.
they hate that.
Like, you cannot just hand a commercial underwriter a spreadsheet that says, we made $1 million last year and I typed plus 10% into Excel, so we will magically make 1.1 million this year.
Yeah, that gets rejected instantly because it lacks causality.
Causality meaning what exactly?
Meaning, lenders insist that projected sales must be built up from actual operational drivers.
Like the physical realities of the restaurant.
Exactly. How many seats are in the dining room? How many table turns? Meaning how many times a single table is seated with new guests? Are you projecting for a slow Tuesday lunch versus a packed Saturday dinner?
Right.
What is your blended average check per person? And most crucially, what are your specific labor and cost of goods sold assumptions based on current 2026 pricing?
You basically have to prove the mechanics of how you will generate every single dollar.
Every single one.
But even with perfect projections, there are deal killers.
Oh, big ones.
Appendix G in the book lists these red flags that will stop a bank completely in its tracks. Things like unfiled taxes, short leases with no renewal options, unverified cash sales, and undocumented payroll.
Undocumented payroll is a perfect example of how a red flag just breaks the math.
Walk us through that.
So, if half your staff is being paid off the books, your historical tax returns do not reflect your actual labor costs.
Because the cash is just disappearing under the table.
Right. So your cash flow on paper looks much higher than it really is.
Yeah.
And the bank cannot legally underwrite that fictional cash flow.
Right.
The moment an underwriter spots that discrepancy, the risk becomes totally unquantifiable to them, and they will pause or kill the deal right there.
Centaur gives a fantastic piece of advice regarding this. He says, a red flag is easiest to solve before a contract is signed.
Which is so true.
It operates exactly like buying a house. Finding out a house has a cracked foundation before you put down your earnest money, I mean, it's annoying, but you can negotiate the price down or just walk away cleanly.
Right, you have options.
But discovering that same cracked foundation during the final week of closing?
Oh, that is an absolute nightmare that traps everybody involved.
Right, so you have to audit your own business and solve the red flags before the bank's underwriter ever opens your file.
And, if you want to mitigate the bank's perception of risk even further, one of the most powerful tools available is seller financing.
Okay, this is when the person selling the restaurant agrees to let the buyer pay a portion of the purchase price over time directly to them, right?
Yeah.
So they're acting almost like a secondary lender.
Yes, exactly. And structurally, this debt usually must be put on standby or subordinated to the senior bank loan.
Just like the CDC and that SBA 504 program we talked about.
Exactly the same concept. It means the primary bank gets paid back first if the business fails.
But why does the bank like that?
Because, as the text notes, seller financing sends a massive psychological and financial signal of confidence to a senior lender.
I mean, it is the seller putting their money where their mouth is.
Basically, yeah.
They are basically saying to the bank, I believe in this new buyer's ability to run my business so much that I am willing to risk my own payout on their success.
Exactly. When the seller leaves their own capital in the deal, the bank feels significantly more comfortable deploying theirs.
That makes a lot of sense. The mechanics of debt, risk, and cash flow that we've unpacked today, they apply far beyond just the hospitality sector.
Oh, universally.
Even if you never plan to buy a multi-million-dollar oceanfront grill, these principles translate to almost any major financial leap you take.
They really do.
Understanding how to calculate a debt service ratio, or learning to logically match loan terms to the actual useful life of an asset, and building financial projections based on cold, hard operational realities rather than just blind hope. I mean, these are incredibly vital skills.
Absolutely vital.
Whether you are pitching a massive corporate project at work, investing your own personal savings, or buying a small neighborhood business, the underlying logic holds up.
I think the ultimate takeaway from Baialat Centaur and Company and Richard Santor's book is this really powerful synthesis.
Yeah.
The very best deals, the ones that actually survive economic downturns and thrive, they require two distinct mindsets working in tandem.
The spreadsheet and the spatula.
Yes. They demand the rigorous, unforgiving mathematical discipline of a commercial lender, paired perfectly with the practical, boots-on-the-ground instincts of a hospitality operator.
You absolutely need the spreadsheet and the spatula to make it work.
Exactly.
But as we wrap up, There is one final, really provocative thought from the text regarding alternative financing.
Oh, this is a great point to end on.
Right. The book notes that new capital sources are increasingly relying on immediate, real-time data. They aren't just looking at last year's tax returns anymore.
Yep.
They are looking at daily credit card receipts, delivery app remittances, and minute-by-minute point-of-sale data.
They're tapping directly into the live transaction stream of the business to assess risk instantaneously.
And as financial technology deepens its integration into, every swipe and transaction, it raises a massive question about the future of this entire industry.
It really does.
Will the traditional lender's credit box and the need for a human underwriter eventually become entirely obsolete?
It's a very real possibility.
Are we heading toward a future where algorithms processing millions of real-time operational data points understand our business cash flow and risk profile better than a human at a bank ever could?
Probably sooner than we think.
Will those 5 core questions be asked in a boardroom or just calculated silently by AI before you even hit submit on a loan application?
Wow.
It is definitely something to ponder the next time you are sitting in that buzzing, perfectly lit restaurant watching the plates go by. You can enjoy the meal, but now you know the math operating invisibly beneath the table.